Welcome to It's the Economy. For those of us who are ruing that the markets are not able to climb up, here's some good news from Indian corporates. The credit quality of Indian companies is excellent. That's the verdict from all the rating agencies for the half year that is ending today, September 30th. Although the credit ratio, that is the number of upgrades divided by the number of downgrades. You know how many times upgrades to downgrades? This has fallen slightly for Crisil data. The positive bit is upgrades are maximum in which sector? Infra, power, roads, renewables, data centers, and downgrades are expectedly in export-oriented sectors, especially those exposed to US tariffs, textiles, shrimps, gems and jewellery. MFI's asset quality also still a little shaky, says the Crisil note. With that, let me welcome my guest, Somasekhar Vemuri, the Chief Criteria Officer at Crisil Ratings, Ravichandran of ICRA, and Sachin Gupta, Chief Rating Officer at CareEdge. Gentlemen, thank you very much indeed for your time. Mr. Vemuri, let me start with you. What's the overall picture? It's looking like your number of upgrades are far more than your number of downgrades, but it is a little less than last year.
Yeah, thank you, Latha, and good morning, everyone. So clearly, with 499 upgrades and about 230 downgrades, our credit ratio is about 2.17 times. It has moderated a little bit from 2.75 that we saw in the first half of previous fiscal. Having said that, it still shows a picture of resilience, especially when you look at the fact that 80% of our rating actions continue to be reaffirmations. And from a sectoral perspective, if you look at it, the domestic-oriented sectors, infrastructure-linked sectors, especially roads, commercial real estate, renewables, construction and engineering, capital goods, and secondary steel. These have accounted almost half of the upgrades that we have seen. And the vulnerability is in the export-oriented sectors, primarily diamond polishers, shrimp exports, and home textiles, on account of the fact that the US tariffs are going to impact these sectors, and these sectors have a fairly higher share of demand coming from the US.
Okay.
So domestic-oriented economies, there are tailwinds, whereas for the exports, there are a bit of headwinds.
Okay. Well, let me take BFSI, banking finance in particular. Mr. Ravichandran, what does it look like? We've seen a period when banks reported excellent, or rather very low credit costs and excellent asset quality. How does it work out in the first half gone by and in the coming second half?
Yeah, in fact, in our portfolio, financial sector was the only sector where we saw credit ratio less than 1 time, which means we had more downgrades than upgrades. Most of these downgrades happened in the NBFC space, not in the banking space.
Oh.
The NBFC, microfinance institutions and NBFCs who are exposed to unsecured, MSMEs and unsecured personal loans and so on and so forth. In these three categories, we saw elevated asset quality pressures and high credit cost, and certain cases there were significant covenant breaches resulting in acceleration of debt by the lenders and liquidity-related pressures and so on and so forth. And because of that, financial sector saw high downgrades. And in the near term also, we are closely watching this space, and we believe that credit quality may not improve anytime soon in this space. And add to that, recently, with the H1B related issue, even the lenders who are lending to educational purposes, even those category may be marginally impacted. Of course, we'll have to closely watch as to how things unfold. So NBFCs.
One minute, Mr. Ravichandran. Which specific category of NBFCs you said? MFIs, yes. Anything other than MFIs also in trouble?
Yeah, apart from MFI, there are some NBFCs who are lending to MSMEs.
Okay.
SME-focused, lenders. Especially in certain regions, the SMEs have not been in pink of health, and there have been delay in payments by them, and because of that, asset quality has been, under pressure for some of the NBFCs who are concentrated in the MSME lending.
Okay.
And we had one default, also investment grade default, in this space because of the elevated, asset quality pressure.
Okay. Let me come to Sachin. What I see from yours is that you all have a large number of non-AAA companies coming to you for rating. And it looks like there is a substantial improvement actually at the sub-investment grade level. Can you take us through? I mean, looks like your B, number of people in B have been upgraded, number of people in A have been upgraded. Can you take us through the, sub-investment quality as well?
Yeah, thanks, Latha. So, in line with what Som and Ravichandran have mentioned, the growth in the credit quality or the improvement in the credit quality is actually across the spectrum. So, it's not necessarily only sub-investment or investment. We are seeing improvement in both higher rated categories and sub-investment. Okay. In fact, the ratio, if I look at the overall ratio, is still is 2.56x, right, for the overall portfolio that we've done in the first 6 months. For the sub-investment, it's 1.92. So it's slightly lower than that. But yes, within the smaller entities also, there has been, in the segments which are not export focused but more domestic focused, there is an improvement that we're saying that we are seeing. So in hospitals, in small real estate projects or small pharma companies also, we are seeing improvement there, or maybe entities which are supplying to these sectors which are doing well.
Somasekhar, can you tell us what is the worry in the export-oriented sectors? Your press note says that is where 35% of the downgrades came, exporters exposed to the US. Can you give us more nuanced details?
So what we've done is we have looked at a deeper dive of, how are the export-oriented sectors going to be impacted. So totally about $87 billion of merchandise exports were there last year to the US, which accounts for about 20% of our overall merchandise exports. Of this, roughly about $50 billion is currently what is impacted by the tariffs. The remaining 37 is largely unimpacted. And what we've done for the impacted sectors is looked at what is the exposure that these sectors have to the US and how dependent is US on India.
May I stop you for a minute there? That math has been done by every brokerage under the sun, how much exports and how much is to the US. I want to know if they're already showing stress. Jewelry, textiles and shrimps.
Yes. So all these three sectors, we've already seen downgrades in the first half. And they were fairly sizable compared to the portfolio size that we have. Diamond polishers, shrimp exporters, and home textiles. And even from an outlook perspective as well, these sectors continue to remain negative. Because the almost 30 to 50% of their top line comes from the US markets, and it is very difficult, for them to kind of find any alternate sort of destinations very quickly. It will take time for them to rework their market strategies. So they remain vulnerable. And also what has happened is there has been some degree of front loading of exports in the first half in anticipation of the fact that there could be tariffs, etc. There was a lot of front loading which has happened quite a few of these segments. So the real impact will be something which will be more seen and more stark probably in the second half if this 50% kind of tariffs were to continue.
Okay. Ravichandran, which specific SMEs are in trouble? Anything sectoral in what you found?
We found, SMEs who are active in the textile space and engineering. These are the two major clusters where we saw a slowdown and delays in payment by them to the NBFCs, and even banks also. When we look at the banks portfolio, also we see that SME is one space where we are seeing slightly elevated GNPA levels.
Okay, Sachin, what are you seeing in terms of an outlook? Will the good times continue in the second half, or are they looking troubled?
I think it's certainly not as rosy. I think the future is going to be a little bit more, I would say, cautious we have to be than the past. Essentially, the sectors, so there are two levels that we can analyze this. So one is the directly impacted sectors. So all of us, as you said, textiles, gems and jewelry, shrimps, all these will be impacted. And right now the impact is not yet felt because of the front loading that we discussed. But I think if this 50% were to continue over the next 1 or 2 quarters, I think we will start seeing some serious damage. Even on the rating side, most of the rating actions in these sectors have been more of, watch negative or negative outlook, etc. Because somewhere there is hope that these, some the 50% will be kind of taken off and will come down to 25%. But if this were to continue at 50%, then I think there is serious damage
trouble
in these sectors. But yes, still I would not say systemic. I mean, roughly 3 to 4% of our portfolio is covered by these companies which are exposed to US. Yeah, so
I got it. I just want last word from you, Somasekhar, since you have the largest number of companies under your coverage. Outlook. Will that good times continue, barring these pockets of exports?
Yeah, so our outlook is that of resilience. Essentially, we continue to expect upgrades to outnumber downgrades, and domestic-oriented, consumption-oriented, infrastructure sector-oriented segments will continue to see buoyancy. Having said that, the pockets of vulnerability continue to remain in the export segments, and in the financial sector, like what others mentioned, the microfinance is still under watch, as well as unsecured lending is something which also bears watching.
Okay. Thank you very much, gentlemen, for that very quick wrap. I'm sorry that we are out of time and we have a lot of rating agencies covering many companies. But the key takeaway that we got from all their data is that sector which was responsible for all the bad loans between 2012 and 2016 or 17, infrastructure is the best performing sector with power absolutely, powering ahead, especially including renewables and data centers, which of course consume a lot of power. So infrastructure, thumbs up. That's the message we get from the rating agencies. Wrap up on Bazaar. Chartbusters coming.